we believe individual owners in medium or high tax brackets, as distinguished from tax-free entities such as pension funds, eleemosynary institutions, etc., should expect no real long-term return from the average American corporation, even though these individuals reinvest the entire after-tax proceeds from all dividends they receive. The average return on equity of corporations is fully offset by the combination of the implicit tax on capital levied by inflation and the explicit taxes levied both on dividends and gains in value produced by retained earnings. As we said last year, Berkshire has no corporate solution to the problem. We'll say it again next year, too. Inflation does not improve our return on equity. Indexing is the insulation that all seek against inflation. But the great bulk, although there are important exceptions, of corporate capital is not even partially indexed. Of course, earnings and dividends per share usually will rise if significant earnings are saved by a corporation, i.e., reinvested instead of paid as dividends. But that would be true without inflation.
A thrifty wage earner, likewise, could achieve regular annual increases in his total income without ever getting a pay increase, if he were willing to take only half of his paycheck in cash, his wage, dividend, and consistently add the other half, his retained earnings, to a savings account.
Neither this high-saving wage earner nor the stockholder in a high-saving corporation whose annual dividend rate increases while its rate of return on equity remains flat is truly indexed.
For capital to be truly indexed, return on equity must rise, i.e., business earnings consistently must increase in proportion to the increase in the price level without any need for the business to add to capital, including working capital, employed.
Increased earnings produced by increased investment don't count. Only a few businesses come close to exhibiting this ability. And Berkshire Hathaway isn't one of them. We, of course, have a corporate policy of reinvesting earnings for growth, diversity and strength, which has the incidental effect of minimizing the current imposition of explicit taxes on our owners. However, on a day-by-day basis, you will be subjected to the implicit inflation tax, and when you wish to transfer your investment in Berkshire into another form of investment, or into consumption, you also will face explicit taxes. Sources of earnings. The table below shows the sources of Berkshire's reported earnings. Berkshire owns about 60% of blue chip stamps, which in turn owns 80% of Wesco Financial Corporation. The table shows aggregate earnings of the various business entities, as well as Berkshire's share of those earnings. All of the significant capital gains and losses attributable to any of the business entities are aggregated in the realized securities gains figure at the bottom of the table, and are not included in operating earnings. Our calculation of operating earnings also excludes the gain from sale of Mutual's branch offices. In this respect, it differs from the presentation in our audited financial statements that includes this item in the calculation of earnings before realized investment gain. Earnings before income taxes. Net earnings after tax. Total Berkshire share O of $S1980, 1979, 1980, 1979, 1980, 1979 total. All entities $85,945, $68,632, $70,146, $54,350, $53,122, $39,242. Earnings from operations. Insurance Group. Underwriting $6,738, $3,742, $6,737, $3,741, $3,637, $2,214. Net investment income $30,939, $24,224, $30,927, $24,216, $25,607, $20,106. Berkshire Wambeck Textiles, $508, $1,723, $508, $1,723, $202, $848. Associated Retail Stores, Inc. $2,440, $2,775, $2,440, $2,775, $1,169, $1,280, See's Candies $15,031, $12,785, $8,958, $7,598, $4,212, $3,448, Buffalo Evening News $2,805, $4,617, $1,672, $2,744, $816, $1,333, Blue Chip Stamps. Parent $7,699, $2,397, $4,588, $1,425, $3,060, $1,624, Illinois National Bank and Trust Company $5,324, $5,747, $5,200, $5,614, $4,731, $5,027, Wesco Financial Corporation. Parent $2,916, $2,413, $1,392, $1,098, $1,044, $937, Mutual Savings and Loan Association $5,814, $10,447, $2,775, $4,751, $1,974, $3,261, Precision Steel $2,833, $3,254, $1,352, $1,480, $656, $723, Interest on debt $12,230, $8,248, $9,390, $5,860, $4,809, $2,900. Other $2,170, $1,342, $1,590, $996, $1,255, $753, Total earnings from operations $66,361, $57,984, $54,389, $46,813, $41,922, $35,988, Mutual Savings and Loan Sale of Branches $5,873 minus $2,803 to $1,293, Realized Securities Gain $13,711, $10,648, $12,954, $9,614, $9,907, $6,829, Total earnings $85,945, $68,632, $70,146, $56,427, $53,122, $42,817, Blue Chip Stamps and Wesco are public companies with reporting requirements of their own.
On pages 40 to 53 of this report, we have reproduced the narrative reports of the principal executives of both companies, in which they describe 1980 operations. We recommend a careful reading, and suggest that you particularly note the superb job done by Louis Vincenti and Charlie Munger in repositioning Mutual Savings and Loan.
A copy of the full annual report of either company will be mailed to any Berkshire shareholder upon request to Mr. Robert H. Bird for Blue Chip Stamps, 5801 Southeastern Avenue, Los Angeles, California, 90040, or to Mrs.
Betty Deckard for Wesco Financial Corporation, 315 East Colorado Boulevard, Pasadena, California, 91109. As indicated earlier, undistributed earnings in companies we do not control are now fully as important as the reported operating earnings detailed in the preceding table.
The distributed portion, of course, finds its way into the table primarily through the net investment income section of Insurance Group earnings. We show below Berkshire's proportional holdings in those non-controlled businesses for which only distributed earnings, dividends, are included in our own earnings. No of shares company cost, O omitted, market, O omitted, $434,550, Affiliated Publications, Inc. $2,821, $12,222, $464,317. Aluminum Company of America $25,577, $27,685, $475,217. B. Cleveland Cliffs Iron Company $12,942, $15,894, $1,983,812. B. General Foods, Inc. $62,507, $59,889, $7,200,000. Geico Corporation $47,138, $105,300, $2,015,000. Handy and Harmon $21,825, $58,435, $711,180. Interpublic Group of Companies $4,531, $22,135, $1,211,834. Kaiser Aluminum and Chemical Corporation $20,629, $27,569, $282,500. Media General, Inc. $4,545, $8,334, $247,039. B. National Detroit Corporation $5,930, $6,299, $881,500. National Student Marketing $5,128, $5,895, $391,400. Ogilvy and Mather International, Inc. $3,709, $9,981, $370,088. B. Pinkertons, Inc. $12,144, $16,489, $245,700. B. R. J. Reynolds Industries $8,702, $11,228, $1,250,525. B. Safeco Corporation $32,062, $45,177, $151,104. B. The Times Mirror Company $4,447, $6,271, $1,868,600. The Washington Post Company Class B $10,628, $42,277, $667,124. B. E. W.
Woolworth Company $13,583, $16,511, total $298,848, $497,591. All other common stock holdings $26,313, $32,096, total common stocks $325,161, $529,687. All owned by Berkshire or its insurance subsidiaries.
B. Blue Chip and/or Wesco own shares of these companies. All numbers represent Berkshire's net interest in the larger gross holdings of the group. From this table, you can see that our sources of underlying earning power are distributed far differently among industries than would superficially seem the case. For example, our insurance subsidiaries own approximately 3% of Kaiser Aluminum, and 1.25% of Alcoa. Our share of the 1980 earnings of those companies amounts to about $13 million. If translated dollar for dollar into a combination of eventual market value gain and dividends, this figure would have to be reduced by a significant, but not precisely determinable, amount of tax. Perhaps 25% would be a fair assumption. Thus, we have a much larger economic interest in the aluminum business than in practically any of the operating businesses we control and on which we report in more detail. If we maintain our holdings, our long-term performance will be more affected by the future economics of the aluminum industry than it will by direct operating decisions we make concerning most companies over which we exercise managerial control. Geico Corp. Our largest non-controlled holding is 7.2 million shares of Geico Corp., equal to about a 33% equity interest. Normally, an interest of this magnitude, over 20%, would qualify as an investee holding and would require us to reflect a proportionate share of Geico's earnings in our own. However, We purchased our Geico stock pursuant to special orders of the District of Columbia and New York insurance departments, which required that the right to vote the stock be placed with an independent party. Absent the vote, our 33% interest does not qualify for investee treatment. Pinkerton's is a similar situation. Of course, whether or not the undistributed earnings of Geico are picked up annually in our operating earnings figure has nothing to do with their economic value to us, or to you as owners of Berkshire. The value of these retained earnings will be determined by the skill with which they are put to use by Geico management. On this score, we simply couldn't feel better. Geico represents the best of all investment worlds. The coupling of a very important and very hard to duplicate business advantage with an extraordinary management whose skills in operations are matched by skills in capital allocation. As you can see, our holdings cost us $47 million, with about half of this amount invested in 1976 and most of the remainder invested in 1980. At the present dividend rate, our reported earnings from Geico amount to a little over $3 million annually. But we estimate our share of its earning power as on the order of $20 million annually. Thus, undistributed earnings applicable to this holding alone may amount to 40% of total reported operating earnings of Berkshire. We should emphasize that we feel as comfortable with Geico management retaining an estimated $17 million of earnings applicable to our ownership as we would if that sum were in our own hands. In just the last 2 years, Geico, through repurchases of its own stock, has reduced the share equivalents it has outstanding from 34.2 million to 21.6 million, dramatically enhancing the interests of shareholders in a business that simply can't be replicated. The owners could not have been better served. We have written in past reports about the disappointments that usually result from purchase and operation of turnaround businesses. Literally hundreds of turnaround possibilities in dozens of industries have been described to us over the years and, either as participants or as observers, we have tracked performance against expectations. Our conclusion is that, with few exceptions, when a management with a reputation for brilliance tackles a business with a reputation for poor fundamental economics, it is the reputation of the business that remains intact. Geico may appear to be an exception, having been turned around from the very edge of bankruptcy in 1976.
It certainly is true that managerial brilliance was needed for its resuscitation, and that Jack Byrne, upon arrival in that year, supplied that ingredient in abundance.
But it also is true that the fundamental business advantage that Geico had enjoyed, an advantage that previously had produced staggering success, was still intact within the company, although submerged in a sea of financial and operating troubles. Geico was designed to be the low-cost operation in an enormous marketplace, auto insurance, populated largely by companies whose marketing structures restricted adaptation. Run as designed, it could offer unusual value to its customers while earning unusual returns for itself. For decades it had been run in just this manner.
Its troubles in the mid-70s were not produced by any diminution or disappearance of this essential economic advantage. Geico's problems at that time put it in a position analogous to that of American Express in 1964 following the salad oil scandal. Both were one-of-a-kind companies, temporarily reeling from the effects of a fiscal blow that did not destroy their exceptional underlying economics.
The Geico and American Express situations, extraordinary business franchises with a localized excisable cancer, needing, to be sure, a skilled surgeon, should be distinguished from the true turnaround situation in which the managers expect, and need, to pull off a corporate Pygmalion. Whatever the appellation, we are delighted with our Geico holding which, as noted, cost us $47 million. To buy a similar $20 million of earning power in a business with first-class economic characteristics and bright prospects would cost a minimum of $200 million, much more in some industries, if it had to be accomplished through negotiated purchase of an entire company. A 100% interest of that kind gives the owner the options of leveraging the purchase, changing managements, directing cash flow, and selling the business.
It may also provide some excitement around corporate headquarters, less frequently mentioned.
We find it perfectly satisfying that the nature of our insurance business dictates we buy many minority portions of already well-run businesses, at prices far below our share of the total value of the entire business, that do not need management change, redirection of cash flow, or sale. There aren't many Jack Burns in the managerial world, or GEICOs in the business world. What could be better than buying into a partnership with both of them? Insurance industry conditions. The insurance industry's underwriting picture continues to unfold about as we anticipated, with the combined ratio, see definition on page 37, rising from 100.6 in 1979 to an estimated 103.5 in 1980. It is virtually certain that this trend will continue and that industry underwriting losses will mount, significantly and progressively, in 1981 and 1982. To understand why, we recommend that you read the excellent analysis of property casualty competitive dynamics done by Barbara Stewart of Chubb Corp.
In an October 1980 paper,
Chubb's annual report consistently presents the most insightful, candid and well-written discussion of industry conditions. You should get on the company's mailing list. Mrs. Stewart's analysis may not be cheerful, but we think it is very likely to be accurate.
And, unfortunately, a largely unreported but particularly pernicious problem may well prolong and intensify the coming industry agony.
It is not only likely to keep many insurers scrambling for business when underwriting losses hit record levels, it is likely to cause them at such a time to redouble their efforts. This problem arises from the decline in bond prices and the insurance accounting convention that allows companies to carry bonds at amortized cost, regardless of market value. Many insurers own long-term bonds that, at amortized cost, amount to 2 to 3 times net worth. If the level is 3 times, of course, a 1/3 shrink from cost in bond prices, if it were to be recognized on the books, would wipe out net worth. And shrink they have. Some of the largest and best-known property casualty companies currently find themselves with nominal, or even negative, net worth when bond holdings are valued at market. Of course their bonds could rise in price, thereby partially, or conceivably even fully, restoring the integrity of stated net worth. Or they could fall further. We believe that short-term forecasts of stock or bond prices are useless. The forecasts may tell you a great deal about the forecaster. They tell you nothing about the future. It might strike some as strange that an insurance company's survival is threatened when its stock portfolio falls sufficiently in price to reduce net worth significantly, but that an even greater decline in bond prices produces no reaction at all. The industry would respond by pointing out that, no matter what the current price, the bonds will be paid in full at maturity, thereby eventually eliminating any interim price decline. It may take 20, 30, or even 40 years, this argument says, but, as long as the bonds don't have to be sold, in the end they'll all be worth face value. Of course, if they are sold, even if they are replaced with similar bonds offering better relative value, the loss must be booked immediately. And, just as promptly, published net worth must be adjusted downward by the amount of the loss. Under such circumstances, a great many investment options disappear, perhaps for decades. For example, when large underwriting losses are in prospect, it may make excellent business logic for some insurers to shift from tax-exempt bonds into taxable bonds. Unwillingness to recognize major bond losses may be the sole factor that prevents such a sensible move. But the full implications flowing from massive unrealized bond losses are far more serious than just the immobilization of investment intellect. For the source of funds to purchase and hold those bonds is a pool of money derived from policyholders and claimants, with changing faces, money which, in effect, is temporarily on deposit with the insurer. As long as this pool retains its size, no bonds must be sold. If the pool of funds shrinks, which it will if the volume of business declines significantly, assets must be sold to pay off the liabilities. And if those assets consist of bonds with big unrealized losses, such losses will rapidly become realized, decimating net worth in the process. Thus, an insurance company with a bond market value shrinkage approaching stated net worth, of which there are now many, and also faced with inadequate rate levels that are sure to deteriorate further, has two options. One option for management is to tell the underwriters to keep pricing according to the exposure involved. Be sure to get $1 of premium for every dollar of expense cost plus expectable loss cost.
The consequences of this directive are predictable. With most business both price-sensitive and renewable annually, many policies presently on the books will be lost to competitors in rather short order. B. As premium volume shrinks significantly, there will be a lagged but corresponding decrease in liabilities. Unearned premiums and claims payable, C. Assets, bonds, must be sold to match the decrease in liabilities. And D. The formerly unrecognized disappearance of net worth will become partially recognized, depending upon the extent of such sales, in the insurer's published financial statements.
Variations of this depressing sequence involve a smaller penalty to stated net worth. The reaction of some companies at C would be to sell either stocks that are already carried at market values or recently purchased bonds involving less severe losses. This ostrich-like behavior, selling the better assets and keeping the biggest losers, while less painful in the short term, is unlikely to be a winner in the long term. The second option is much simpler. Just keep writing business regardless of rate levels and whopping prospective underwriting losses, thereby maintaining the present levels of premiums, assets and liabilities, and then pray for a better day, either for underwriting or for bond prices. There is much criticism in the trade press of cash flow underwriting, i.e., writing business regardless of prospective underwriting losses in order to obtain funds to invest at current high interest rates. This second option might properly be termed asset maintenance underwriting, the acceptance of terrible business just to keep the assets you now have. Of course, you know which option will be selected. And it also is clear that as long as many large insurers feel compelled to choose that second option, there will be no better day for underwriting. For if much of the industry feels it must maintain premium volume levels regardless of price adequacy, all insurers will have to come close to meeting those prices. Right behind having financial problems yourself, the next worst plight is to have a large group of competitors with financial problems that they can defer by a sell at any price policy. We mentioned earlier that companies that were unwilling, for any of a number of reasons, including public reaction, institutional pride, or protection of stated net worth, to sell bonds at price levels forcing recognition of major losses might find themselves frozen in investment posture for a decade or longer. But, as noted, that's only half of the problem. Companies that have made extensive commitments to long-term bonds may have lost, for a considerable period of time, not only many of their investment options, but many of their underwriting options as well. Our own position in this respect is satisfactory. We believe our net worth, valuing bonds of all insurers at amortized cost, is the strongest relative to premium volume among all large property casualty stockholder-owned groups. When bonds are valued at market, our relative strength becomes far more dramatic. But lest we get too puffed up, we remind ourselves that our asset and liability maturities still are far more mismatched than we would wish, and that we, too, lost important sums in bonds because your chairman was talking when he should have been acting. Our abundant capital and investment flexibility will enable us to do whatever we think makes the most sense during the prospective extended period of inadequate pricing. But troubles for the industry mean troubles for us. Our financial strength doesn't remove us from the hostile pricing environment now enveloping the entire property casualty insurance industry. It just gives us more staying power and more options. Insurance operations. The National Indemnity Managers, led by Phil Leach with the usual able assistance of Roland Miller and Bill Lyons, outdid themselves in 1980. While volume was flat, underwriting margins relative to the industry were at an all-time high. We expect decreased volume from this operation in 1981. But its managers will hear no complaints from corporate headquarters, nor will employment or salaries suffer. We enormously admire the national indemnity underwriting discipline, embedded from origin by the founder, Jack Ringwalt, and know that this discipline, if suspended, probably could not be fully regained. John Seward at Home and Auto continues to make good progress in replacing a diminishing number of auto policies with volume from less competitive lines, primarily small premium general liability. Operations are being slowly expanded, both geographically and by product line, as warranted by underwriting results. The reinsurance business continues to reflect the excesses and problems of the primary writers. Worse yet, it has the potential for magnifying such excesses. Reinsurance is characterized by extreme ease of entry, large premium payments in advance, and much delayed loss reports and loss payments. Initially, the morning mail brings lots of cash and few claims. This state of affairs can produce a blissful, almost euphoric, feeling akin to that experienced by an innocent upon receipt of his first credit card. The magnetic lure of such cash-generating characteristics, currently enhanced by the presence of high interest rates, is transforming the reinsurance market into amateur night. Without a super catastrophe, industry underwriting will be poor in the next few years. If we experience such a catastrophe, there could be a bloodbath with some companies not able to live up to contractual commitments. George Young continues to do a first-class job for us in this business. Results, with investment income included, have been reasonably profitable. We will retain an active reinsurance presence, but, for the foreseeable future, we expect no premium growth from this activity. We continue to have serious problems in the home state operation. Floyd Taylor in Kansas has done an outstanding job, but our underwriting record elsewhere is considerably below average. Our poorest performer has been Insurance Company of Iowa, at which large losses have been sustained annually since its founding in 1973. Late in the fall, we abandoned underwriting in that state, and have merged the company into Cornhusker Casualty. There is potential in the home state concept, but much work needs to be done in order to realize it. Our workers' compensation operation suffered a severe loss when Frank DiNardo died last year at 37. Frank instinctively thought like an underwriter. He was a superb technician and a fierce competitor. In short order, he had straightened out major problems at the California Workers' Compensation Division of National Indemnity. Dan Grossman, who originally brought Frank to us, stepped in immediately after Frank's death to continue that operation, which now utilizes Redwood Fire and Casualty, another Berkshire subsidiary, as the insuring vehicle. Our major workers' compensation operation, Cypress Insurance Company, run by Milt Thornton, continues its outstanding record. Year after year, Milt, like Phil Leash, runs an underwriting operation that far outpaces his competition. In the industry, he is admired and copied, but not matched. Overall, we look for a significant decline in insurance volume in 1981 along with a poorer underwriting result.
We expect underwriting experience somewhat superior to that of the industry, but, of course, so does most of the industry.
There will be some disappointments. Textile and retail operations. During the past year, we have cut back the scope of our textile business. Operations at Wambeck Mills have been terminated, reluctantly but necessarily. Some equipment was transferred to New Bedford, but most has been sold, or will be, along with real estate. Your chairman made a costly mistake in not facing the realities of this situation sooner. At New Bedford, we have reduced the number of looms operated by about 1/3, abandoning some high-volume lines in which product differentiation was insignificant. Even assuming everything went right, which it seldom did, these lines could not generate adequate returns related to investment. And, over a full industry cycle, losses were the most likely result. Our remaining textile operation, still sizable, has been divided into a manufacturing and a sales division, each free to do business independent of the other. Thus, distribution strengths and mill capabilities will not be wedded to each other. We have more than doubled capacity in our most profitable textile segment through a recent purchase of used 130-inch Sauer looms. Current conditions indicate another tough year in textiles, but with substantially less capital employed in the operation. Ben Rosner's record at Associated Retail Stores continues to amaze us. In a poor retailing year, Associated's earnings continued excellent, and those earnings all were translated into cash. On March 7, 1981, Associated will celebrate its 50th birthday. Ben has run the business, along with Leo Simon, his partner, from 1931 to 1966, in each of those 50 years. Disposition of Illinois National Bank and Trust of Rockford. On December 31, 1980, we completed the exchange of 41,086 shares of Rockford Bancorp Inc., which owns 97.7% of Illinois National Bank, for a like number of shares of Berkshire Hathaway Inc.
Our method of exchange allowed all Berkshire shareholders to maintain their proportional interest in the bank, except for me. I was permitted 80% of my proportional share. They were thus guaranteed an ownership position identical to that they would have attained had we followed a more conventional spin-off approach.
24 shareholders, of our approximate 1,300, chose this proportional exchange option. We also allowed overexchanges, and 39 additional shareholders accepted this option, thereby increasing their ownership in the bank and decreasing their proportional ownership in Berkshire. All got the full amount of Bancorp stock they requested, since the total shares desired by these 39 holders was just slightly less than the number left available by the remaining 1,200-plus holders of Berkshire who elected not to part with any Berkshire shares at all.
As the exchanger of last resort, I took the small balance, 3% of Bancorp's stock. These shares, added to shares I received from my basic exchange allotment, 80% of normal, gave me a slightly reduced proportional interest in the bank and a slightly enlarged proportional interest in Berkshire.
Management of the bank is pleased with the outcome. Bancorp will operate as an inexpensive and uncomplicated holding company owned by 65 shareholders. And all of those shareholders will have become Bancorp owners through a conscious affirmative decision. Financing. In August, we sold $60 million of 12.75% notes due August 1, 2005, with a sinking fund to begin in 1991. The managing underwriters, Donaldson, Lufkin and Genret Securities Corporation, represented by Bill Fisher, and Chili's, Hyder & Company, Inc., represented by Charlie Hyder, did an absolutely first-class job from start to finish of the financing. Unlike most businesses, Berkshire did not finance because any specific immediate needs.
Rather, we borrowed because we think that, over a period far shorter than the life of the loan, we will have many opportunities to put the money to good use.
The most attractive opportunities may present themselves at a time when credit is extremely expensive, or even unavailable.
At such a time, we want to have plenty of financial firepower.
Our acquisition preferences run toward businesses that generate cash, not those that consume it. As inflation intensifies, more and more companies find that they must spend all funds they generate internally just to maintain their existing physical volume of business. There is a certain mirage-like quality to such operations.
However attractive the earnings numbers, we remain leery of businesses that never seem able to convert such pretty numbers into no-strings-attached cash.
Businesses meeting our standards are not easy to find. Each year we read of hundreds of corporate acquisitions, only a handful would have been of interest to us. And logical expansion of our present operations is not easy to implement. But we'll continue to utilize both avenues in our attempts to further Berkshire's growth. Under all circumstances, we plan to operate with plenty of liquidity, with debt that is moderate in size and properly structured, and with an abundance of capital strength. Our return on equity is penalized somewhat by this conservative approach, but it is the only one with which we feel comfortable. Gene Abig, founder of our long-owned bank in Rockford, died on July 2, 1980 at the age of 82. As a friend, banker and citizen, he was unsurpassed.
You learn a great deal about a person when you purchase a business from him and he then stays on to run it as an employee rather than as an owner.
Before the purchase, the seller knows the business intimately, whereas you start from scratch. The seller has dozens of opportunities to mislead the buyer, through omissions, ambiguities, and misdirection.
After the check has changed hands, subtle, and not so subtle, changes of attitude can occur and implicit understandings can evaporate.
As in the courtship-marriage sequence, disappointments are not infrequent. From the time we first met, Gene shot straight 100% of the time, the only behavior pattern he had within him. At the outset of negotiations, he laid all negative factors face up on the table. On the other hand, For years after the transaction was completed, he would tell me periodically of some previously undiscussed items of value that had come with our purchase. Though he was already 71 years of age when he sold us the bank, Gene subsequently worked harder for us than he had for himself. He never delayed reporting a problem for a minute, but problems were few with Gene. What else would you expect from a man who, at the time of the bank holiday in 1933, had enough cash on the premises to pay all depositors in full? Gene never forgot he was handling other people's money.
Though this fiduciary attitude was always dominant, his superb managerial skills enabled the bank to regularly achieve the top position nationally in profitability.
Gene was in charge of the Illinois National for close to 50 years, almost 1/4 of the lifetime of our country. George Meade, a wealthy industrialist, brought him in from Chicago to open a new bank after a number of other banks in Rockford had failed. Mr. Meade put up the money and Gene ran the show. His talent for leadership soon put its stamp on virtually every major civic activity in Rockford. Dozens of Rockford citizens have told me over the years of help Gene extended to them. In some cases this help was financial. In all cases it involved much wisdom, empathy and friendship. He always offered the same to me. Because of our respective ages and positions, I was sometimes the junior partner, sometimes the senior. Whichever the relationship, it always was a special one, and I miss it. Warren E. Buffett, February 27, 1981, Chairman of the Board, 1981 Letter, Berkshire Hathaway Inc. February 26, 1982, to the shareholders of Berkshire Hathaway Inc. Operating earnings of $39.7 million in 1981 amounted to 15.2% of beginning equity capital, valuing securities at cost, compared to 17.8% in 1980. Our new plan that allows stockholders to designate corporate charitable contributions, detailed later, reduced earnings by about $900,000 in 1981. This program, which we expect to continue subject to annual evaluation of our corporate tax position, had not been initiated in 1980. Non-controlled ownership earnings. In the 1980 annual report we discussed extensively the concept of non-controlled ownership earnings, i.e., Berkshire's share of the undistributed earnings of companies we don't control or significantly influence but in which we, nevertheless, have important investments. We will be glad to make available to new or prospective shareholders copies of that discussion or others from earlier reports to which we refer in this report. No portion of those undistributed earnings is included in the operating earnings of Berkshire.
However, our belief is that, in aggregate, those undistributed and, therefore, unrecorded earnings will be translated into tangible value for Berkshire shareholders just as surely as if subsidiaries we control had earned, retained, and reported similar earnings. We know that this translation of non-controlled ownership earnings into corresponding realized and unrealized capital gains for Berkshire will be extremely irregular as to time of occurrence. While market values track business values quite well over long periods, in any given year the relationship can gyrate capriciously. Market recognition of retained earnings also will be unevenly realized among companies. It will be disappointingly low or negative in cases where earnings are employed non-productively, and far greater than dollar for dollar of retained earnings in cases of companies that achieve high returns with their augmented capital. Overall, if a group of non-controlled companies is selected with reasonable skill, the group result should be quite satisfactory. In aggregate, our non-controlled business interests have more favorable underlying economic characteristics than our controlled businesses. That's understandable. The area of choice has been far wider. Small portions of exceptionally good businesses are usually available in the securities markets at reasonable prices. But such businesses are available for purchase in their entirety only rarely, and then almost always at high prices. General acquisition behavior, as our history indicates, we are comfortable both with total ownership of businesses and with marketable securities representing small portions of businesses. We continually look for ways to employ large sums in each area. But we try to avoid small commitments. If something's not worth doing at all, it's not worth doing well. Indeed,
The liquidity requirements of our insurance and trading stamp businesses mandate major investments in marketable securities.
Our acquisition decisions will be aimed at maximizing real economic benefits, not at maximizing either managerial domain or reported numbers for accounting purposes.
In the long run, managements stressing accounting appearance over economic substance usually achieve little of either. Regardless of the impact upon immediately reportable earnings, we would rather buy 10% of wonderful business T at X per share than 100% of T at 2X per share. Most corporate managers prefer just the reverse, and have no shortage of stated rationales for their behavior.
However, we suspect three motivations, usually unspoken, to be, singly or in combination, the important ones in most high-premium takeovers. 1. Leaders, business or otherwise, seldom are deficient in animal spirits and often relish increased activity and challenge.
At Berkshire, the corporate pulse never beats faster than when an acquisition is in prospect. 2. Most organizations, business or otherwise, measure themselves, are measured by others, and compensate their managers far more by the yardstick of size than by any other yardstick. Ask a Fortune 500 manager where his corporation stands on that famous list and, invariably, the number responded will be from the list ranked by size of sales. He may well not even know where his corporation places on the list. Fortune just as faithfully compiles ranking the same 500 corporations by profitability. 3. Many managements apparently were overexposed in impressionable childhood years to the story in which the imprisoned handsome prince is released from a toad's body by a kiss from a beautiful princess. Consequently, they are certain their managerial kiss will do wonders for the profitability of Company T. Argot. Such optimism is essential. Absent that rosy view, why else should the shareholders of Company A, Quisitor, want to own an interest in T at the 2x takeover cost rather than at the X market price they would pay if they made direct purchases on their own? In other words, investors can always buy toads at the going price for toads. If investors instead bankroll princesses who wish to pay double for the right to kiss the toad, those kisses had better pack some real dynamite. We've observed many kisses but very few miracles. Nevertheless, many managerial princesses remain serenely confident about the future potency of their kisses, even after their corporate backyards are knee-deep in unresponsive toads. In fairness, we should acknowledge that some acquisition records have been dazzling. Two major categories stand out. The first involves companies that, through design or accident, have purchased only businesses that are particularly well adapted to an inflationary environment. Such favored business must have two characteristics. 1. An ability to increase prices rather easily, even when product demand is flat and capacity is not fully utilized, without fear of significant loss of either market share or unit volume. And 2. An ability to accommodate large dollar volume increases in business, often produced more by inflation than by real growth, with only minor additional investment of capital. Managers of ordinary ability, focusing solely on acquisition possibilities meeting these tests, have achieved excellent results in recent decades. However, very few enterprises possess both characteristics, and competition to buy those that do has now become fierce to the point of being self-defeating. The second category involves the managerial superstars, men who can recognize that rare prince who is disguised as a toad, and who have managerial abilities that enable them to peel away the disguise. We salute such managers as Ben Heinemann at Northwest Industries, Henry Singleton at Teledyne, Erwin Zabin at National Service Industries, and especially Tom Murphy at Capital Cities Communications, a real managerial twofer, whose acquisition efforts have been properly focused in Category 1 and whose operating talents also make him a leader of Category 2. From both direct and vicarious experience, we recognize the difficulty and rarity of these executives' achievements. So do they. These champs have made very few deals in recent years, and often have found repurchase of their own shares to be the most sensible employment of corporate capital. Your chairman, unfortunately, does not qualify for Category 2. And, despite a reasonably good understanding of the economic factors compelling concentration in Category 1, our actual acquisition activity in that category has been sporadic and inadequate. Our preaching was better than our performance. We neglected the Noah principle. Predicting rain doesn't count, building arks does. We have tried occasionally to buy toads at bargain prices with results that have been chronicled in past reports. Clearly our kisses fell flat. We have done well with a couple of princes, but they were princes when purchased. At least our kisses didn't turn them into toads. And, finally, we have occasionally been quite successful in purchasing fractional interests in easily identifiable princes at toad-like prices. Berkshire acquisition objectives: we will continue to seek the acquisition of businesses in their entirety at prices that will make sense, even should the future of the acquired enterprise develop much along the lines of its past.
We may very well pay a fairly fancy price for a Category 1 business if we are reasonably confident of what we are getting.
But we will not normally pay a lot in any purchase for what we are supposed to bring to the party, for we find that we ordinarily don't bring a lot.
During 1981, we came quite close to a major purchase involving both a business and a manager we liked very much.
However, the price finally demanded, considering alternative uses for the funds involved, would have left our owners worse off than before the purchase. The empire would have been larger, but the citizenry would have been poorer. Although we had no success in 1981, from time to time in the future we will be able to purchase 100% of businesses meeting our standards. Additionally, we expect an occasional offering of a major non-voting partnership, as discussed under the Pinkertons heading on page 47 of this report. We welcome suggestions regarding such companies where we, as a substantial junior partner, can achieve good economic results while furthering the long-term objectives of present owners and managers. Currently, we find values most easily obtained through the open market purchase of fractional positions in companies with excellent business franchises and competent, honest managements. We never expect to run these companies, but we do expect to profit from them. We expect that undistributed earnings from such companies will produce full value, subject to tax when realized, for Berkshire and its shareholders. If they don't, we have made mistakes as to either 1. The management we have elected to join, 2. The future economics of the business, or 3. The price we have paid.
We have made plenty of such mistakes, both in the purchase of non-controlling and controlling interests in businesses.
Category 2. Miscalculations are the most common. Of course, it is necessary to dig deep into our history to find illustrations of such mistakes, sometimes as deep as 2 or 3 months back. For example, last year your chairman volunteered his expert opinion on the rosy future of the aluminum business. Several minor adjustments to that opinion, now aggregating approximately 180 degrees, have since been required. For personal as well as more objective reasons, however, we generally have been able to correct such mistakes far more quickly in the case of non-controlled businesses, marketable securities, than in the case of controlled subsidiaries. Lack of control, in effect, often has turned out to be an economic plus. As we mentioned last year, the magnitude of our non-recorded ownership earnings has grown to the point where their total is greater than our reported operating earnings. We expect this situation will continue. In just 4 ownership positions in this category, Geico Corporation, General Foods Corporation, R.J. Reynolds Industries, Inc., and the Washington Post Company, our share of undistributed and therefore unrecorded earnings probably will total well over $35 million in 1982. The accounting rules that entirely ignore these undistributed earnings diminish the utility of our annual return on equity calculation, or any other single-year measure of economic performance. Long-term corporate performance: in measuring long-term economic performance, equities held by our insurance subsidiaries are valued at market subject to a charge reflecting the amount of taxes that would have to be paid if unrealized gains were actually realized. If we are correct in the premise stressed in the preceding section of this report, our unreported ownership earnings will find their way, irregularly but inevitably, into our net worth. To date, this has been the case. An even purer calculation of performance would involve evaluation of bonds and non-insurance held equities at market. However, GAAP accounting does not prescribe this procedure, and the added purity would change results only very slightly. Should any valuation difference widen to significant proportions, as it has at most major insurance companies, we will report its effect to you. On a GAAP basis, during the present management's term of 17 years, book value has increased from $19.46 per share to $526.02 per share, or 21.1% compounded annually. This rate of return number is highly likely to drift downward in future years. We hope, however, that it can be maintained significantly above the rate of return achieved by the average large American corporation. Over half of the large gain in Berkshire's net worth during 1981, it totaled $124 million, or about 31%, resulted from the market performance of a single investment, Geico Corporation. In aggregate, our market gain from securities during the year considerably outstripped the gain in underlying business values. Such market variations will not always be on the pleasant side. In past reports, we have explained how inflation has caused our apparently satisfactory long-term corporate performance to be illusory as a measure of true investment results for our owners. We applaud the efforts of Federal Reserve Chairman Volcker and note the currently more moderate increases in various price indices. Nevertheless, our views regarding long-term inflationary trends are as negative as ever. Like virginity, a stable price level seems capable of maintenance, but not of restoration.
Despite the overriding importance of inflation in the investment equation, we will not punish you further with another full recital of our views. Inflation itself will be punishment enough. Copies of previous discussions are available for masochists. But, because of the unrelenting destruction of currency values, our corporate efforts will continue to do a much better job of filling your wallet than of filling your stomach.
Equity value added, an additional factor, should further subdue any residual enthusiasm you may retain regarding our long-term rate of return.
The economic case justifying equity investment is that, in aggregate, additional earnings above passive investment returns, interest on fixed income securities, will be derived through the employment of managerial and entrepreneurial skills in conjunction with that equity capital.
Furthermore, the case says that since the equity capital position is associated with greater risk than passive forms of investment, it is entitled to higher returns. A value-added bonus from equity capital seems natural and certain. But is it?
Several decades back, a return on equity of as little as 10% enabled a corporation to be classified as a good business, i.e., one in which a dollar reinvested in the business logically could be expected to be valued by the market at more than 100 cents. For, with long-term taxable bonds yielding 5% and long-term tax-exempt bonds 3%, a business operation that could utilize equity capital at 10% clearly was worth some premium to investors over the equity capital employed. That was true even though a combination of taxes on dividends and on capital gains would reduce the 10% earned by the corporation to perhaps 6% to 8% in the hands of the individual investor. Investment markets recognized this truth. During that earlier period, American business earned an average of 11% or so on equity capital employed in stocks, in aggregate, sold at valuations far above that equity capital, book value, averaging over 150 cents on the dollar. Most businesses were good businesses because they earned far more than their keep, the return on long-term passive money. The value added produced by equity investment, in aggregate, was substantial. That day is gone. But the lessons learned during its existence are difficult to discard. While investors and managers must place their feet in the future, their memories and nervous systems often remain plugged into the past. It is much easier for investors to utilize historic P/E ratios or for managers to utilize historic business valuation yardsticks than it is for either group to rethink their premises daily. When change is slow, constant rethinking is actually undesirable. It achieves little and slows response time. But when change is great, yesterday's assumptions can be retained only at great cost. And the pace of economic change has become breathtaking. During the past year, long-term taxable bond yields exceeded 16% and long-term tax-exempts 14%. The total return achieved from such tax exempts, of course, goes directly into the pocket of the individual owner.
Meanwhile, American business is producing earnings of only about 14% on equity. And this 14% will be substantially reduced by taxation before it can be banked by the individual owner. The extent of such shrinkage depends upon the dividend policy of the corporation and the tax rates applicable to the investor. Thus, with interest rates on passive investments at late 1981 levels, a typical American business is no longer worth 100 cents on the dollar to owners who are individuals. If the business is owned by pension funds or other tax-exempt investors, the arithmetic, although still unenticing, changes substantially for the better. Assume an investor in a 50% tax bracket. If our typical company pays out all earnings, the income return to the investor will be equivalent to that from a 7% tax-exempt bond. And, if conditions persist, if all earnings are paid out and return on equity stays at 14%, the 7% tax-exempt equivalent to the higher bracket individual investor is just as frozen as is the coupon on a tax-exempt bond. Such a perpetual 7% tax-exempt bond might be worth 50 cents on the dollar as this is written. If, on the other hand, all earnings of our typical American business are retained and return on equity again remains constant, earnings will grow at 14% per year. If the P/E ratio remains constant, the price of our typical stock will also grow at 14% per year. But that 14% is not yet in the pocket of the shareholder. Putting it there will require the payment of a capital gains tax, presently assessed at a maximum rate of 20%. This net return, of course, works out to a poorer rate of return than the currently available passive after-tax rate. Unless passive rates fall, companies achieving 14% per year gains in earnings per share while paying no cash dividend are an economic failure for their individual shareholders. The returns from passive capital outstrip the returns from active capital. This is an unpleasant fact for both investors and corporate managers and, therefore, one they may wish to ignore. But facts do not cease to exist, either because they are unpleasant or because they are ignored. Most American businesses pay out a significant portion of their earnings and thus fall between the two examples. And most American businesses are currently bad businesses economically, producing less for their individual investors after tax than the tax-exempt passive rate of return on money. Of course, some high-return businesses still remain attractive, even under present conditions. But American equity capital, in aggregate, produces no value added for individual investors. It should be stressed that this depressing situation does not occur because corporations are jumping, economically, less high than previously. In fact, they are jumping somewhat higher. Return on equity has improved a few points in the past decade. But the crossbar of passive return has been elevated much faster. Unhappily, most companies can do little but hope that the bar will be lowered significantly. There are few industries in which the prospects seem bright for substantial gains in return on equity. Inflationary experience and expectations will be major, but not the only factors affecting the height of the crossbar in future years. If the causes of long-term inflation can be tempered, passive returns are likely to fall and the intrinsic position of American equity capital should significantly improve. Many businesses that now must be classified as economically bad would be restored to the good category under such circumstances. A further, particularly ironic, punishment is inflicted by an inflationary environment upon the owners of the bad business. To continue operating in its present mode, such a low-return business usually must retain much of its earnings, no matter what penalty such a policy produces for shareholders. Reason, of course, would prescribe just the opposite policy. An individual, stuck with a 5% bond with many years to run before maturity, does not take the coupons from that bond and pay 100 cents on the dollar for more 5% bonds while similar bonds are available at, say, 40 cents on the dollar. Instead, he takes those coupons from his low-return bond and, if inclined to reinvest, looks for the highest return with safety currently available. Good money is not thrown after bad. What makes sense for the bondholder makes sense for the shareholder. Logically, A company with historic and prospective high returns on equity should retain much or all of its earnings so that shareholders can earn premium returns on enhanced capital. Conversely, low returns on corporate equity would suggest a very high dividend payout so that owners could direct capital toward more attractive areas. The scriptures concur. In the parable of the talents, the two high-earning servants are rewarded with 100% retention of earnings and encouraged to expand their operations. However, the non-earning third servant is not only chastised, wicked and slothful, but also is required to redirect all of his capital to the top performer. Matthew chapter 25 verses 14 to 30. But inflation takes us through the looking glass into the upside-down world of Alice in Wonderland. When prices continuously rise, the bad business must retain every nickel that it can. Not because it is attractive as a repository for equity capital, but precisely because it is so unattractive, the low-return business must follow a high retention policy. If it wishes to continue operating in the future as it has in the past, and most entities, including businesses, do, it simply has no choice. For inflation acts as a gigantic corporate tapeworm. That tapeworm preemptively consumes its requisite daily diet of investment dollars regardless of the health of the host organism. Whatever the level of reported profits, even if nil, more dollars for receivables, inventory and fixed assets are continuously required by the business in order to merely match the unit volume of the previous year. The less prosperous the enterprise, the greater the proportion of available sustenance claimed by the tapeworm. Under present conditions, a business earning 8% or 10% on equity often has no leftovers for expansion, debt reduction or real dividends. The tapeworm of inflation simply cleans the plate. The low-return company's inability to pay dividends, understandably, is often disguised. Corporate America increasingly is turning to dividend reinvestment plans, sometimes even embodying a discount arrangement that all but forces shareholders to reinvest. Other companies sell newly issued shares to Peter in order to pay dividends to Paul. Beware of dividends that can be paid out only if someone promises to replace the capital distributed. Berkshire continues to retain its earnings for offensive, not defensive or obligatory, reasons. But in no way are we immune from the pressures that escalating passive returns exert on equity capital. We continue to clear the crossbar of after-tax passive return, but barely. Our historic 21% return, not at all assured for the future, still provides, after the current capital gain tax rate, which we expect to rise considerably in future years, a modest margin over current after-tax rates on passive money. It would be a bit humiliating to have our corporate value added turn negative. But it can happen here as it has elsewhere, either from events outside anyone's control or from poor relative adaptation on our part. Sources of reported earnings. The table below shows the sources of Berkshire's reported earnings. Berkshire owns about 60% of blue chip stamps, which, in turn, owns 80% of Wesco Financial Corporation. The table displays aggregate operating earnings of the various business entities, as well as Berkshire's share of those earnings. All of the significant gains and losses attributable to unusual sales of assets by any of the business entities are aggregated with securities transactions in the line near the bottom of the table and are not included in operating earnings. Earnings before income taxes. Net earnings after tax. Total Berkshire share O of $S1981, 1980, 1981, 1980, 1981, 1980. Total all entities $85,945, $85,945, $70,146, $70,146, $53,122, $53,122. Operating earnings. Underwriting $1,478, $6,738, $1,478, $6,737, $798, $3,637. Net investment income $38,823, $30,939, $38,823, $30,927, $32,401, $25,607. Berkshire Wambeck Textiles $2,669, $508. $2,669. $508. $1,493. $202. Associated Retail Stores $1,763. $2,440. $1,763. $2,440. $759. $1,169. See's Candies $21,891. $15,475. $13,046. $9,223. $6,289. $4,459. Buffalo Evening News $1,057. $2,777. $630. $1,655. $276. $800. Blue Chip Stamps Parent $3,642. $7,699. $2,171. $4,588. $2,134. $3,060. Wesco Financial Parent $4,495. $2,916. $2,145. $1,392. $1,590. $1,044. Mutual Savings and Loan $1,605. $5,814. $766. $2,775. $1,536. $1,974. Precision Steel $3,453. $2,833. $1,648. $1,352. $841. $656. Interest on debt $14,656. $12,230. $12,649. $9,390. $6,671. $4,809. Other $1,895. $1,698. $1,344. $1,308. $1,513. $992. Subtotal Continuing Operations $60,663. $61,037. $47,236. $49,189. $39,421. $37,191. Illinois National Bank $5,324 to -$5,200. $4,731. Operating earnings $60,663. $66,361. $47,236. $54,389. $39,421. $41,922. Sale of securities and unusual sales of assets $37,801. $19,584. $33,150. $15,757. $23,183. $11,200. Total earnings all entities $98,464. $85,945. $80,386. $70,146. $62,604. $53,122. Amortization of intangibles arising in accounting for purchases of businesses, IECs, Mutual and Buffalo Evening News, is reflected in the category designated as Other. Berkshire divested itself of its ownership of the Illinois National Bank on December 31, 1980. Blue Chip Stamps and Wesco are public companies with reporting requirements of their own. On pages 38 to 50 of this report we have reproduced the narrative reports of the principal executives of both companies, in which they describe 1981 operations. A copy of the full annual report of either company will be mailed to any Berkshire shareholder upon request to Mr. Robert H. Bird for Blue Chip Stamps, 5801 Southeastern Avenue, Los Angeles, California, 90040, or to Mrs. Jean Leach for Wesco Financial Corporation, 315 East Colorado Boulevard, Pasadena, California, 91109. As we indicated earlier, undistributed earnings in companies we do not control are not fully as important as the reported operating earnings detailed in the preceding table. The distributed portion of earnings, of course, finds its way into the table primarily through the net investment income segment of insurance group earnings. We show below Berkshire's proportional holdings in those non-controlled businesses for which only distributed earnings, dividends, are included in our earnings. No of shares company cost. O omitted, market. O omitted, 451,650. Affiliated publications, Inc. $3,297, $14,114, $703,634. Aluminum Company of America $19,359, $18,031, $420,441. Arcata Corporation $14,076, $15,136, $475,217. B. Cleveland Cliffs Iron Company $12,942, $14,362, $441,522. Gatex Corporation $17,147, $13,466, $2,101,244. B. General Foods, Inc.
$66,277, $66,714, $7,200,000. Geico Corporation $47,138, $199,800, $2,015,000. Handy and Harman $21,825, $36,270, $711,180. Interpublic Group of Companies $4,531, $23,202, $282,500. Media General, Inc.
$4,545, $11,088, $391,400. Ogilvy and Mather International, Inc. $3,709, $12,329, $370,088. B. Pinkertons, Inc. $12,144, $19,675, $1,764,824. B. R. J.
Reynolds Industries $76,668, $83,127, $785,225. B. Safeco Corporation $21,329, $31,016, $151,104. B. The Times Mirror Company $4,447, $6,271, $1,868,600. The Washington Post Company Class B $10,628, $58,160, total $335,615, $616,490. All other common stock holdings $16,131, $22,739, total common stocks $351,746, $639,229. All owned by Berkshire or its insurance subsidiaries.
B. Blue Chip and/or Wesco own shares of these companies. All numbers represent Berkshire's net interest in the larger gross holdings of the group. Our controlled and non-controlled businesses operate over such a wide spectrum of activities that detailed commentary here would prove too lengthy. Much additional financial information is included in management's discussion on pages 34 to 37 and in the narrative reports on pages 38 to 50.
However, our largest area of both controlled and non-controlled activity has been, and almost certainly will continue to be, the property casualty insurance area, and commentary on important developments in that industry is appropriate.
Insurance industry conditions, forecasts, said Sam Goldwyn, are dangerous, particularly those about the future. Berkshire shareholders may have reached a similar conclusion after rereading our past annual reports featuring your chairman's prescient analysis of textile prospects. There is no danger, however, in forecasting that 1982 will be the worst year in recent history for insurance underwriting. That result already has been guaranteed by present pricing behavior, coupled with the term nature of the insurance contract. While many auto policies are priced and sold at 6-month intervals, and many property policies are sold for a 3-year term, a weighted average of the duration of all property casualty insurance policies probably runs a little under 12 months. And prices for the insurance coverage, of course, are frozen for the life of the contract. Thus, this year's sales contracts, premium written in the parlance of the industry, determine about one-half of next year's level of revenue, premiums earned.
The remaining half will be determined by sales contracts written next year that will be about 50% earned in that year.
The profitability consequences are automatic. If you make a mistake in pricing, you have to live with it for an uncomfortable period of time.
Note in the table below the year-over-year gain in industry-wide premiums written and the impact that it has on the current and following year's level of underwriting profitability.
The result is exactly as you would expect in an inflationary world. When the volume gain is well up in double digits, it bodes well for profitability trends in the current and following year. When the industry volume gain is small, underwriting experience very shortly will get worse, no matter how unsatisfactory the current level. The best data in the table reflect the experience of practically the entire industry, including stock, mutual and reciprocal companies. The combined ratio indicates total operating and loss costs as compared to premiums. A ratio below 100 indicates an underwriting profit, and one above 100 indicates a loss. Yearly change in premium written, yearly change in premium earned, combined ratio after policyholder dividends 1972, 10.2%, 10.9%, 96.21973, 8.0%, 8.8%, 99.219746, 6.9%, 6.9%, 105.41975, 11.0%, 9.6%, 107.91976, 21.9%, 19.4%, 102.41977, 19.8%, 20.5%, 97.21978, 12.8%, 14.3%, 97.51979, 10.3%, 10.4%, 100.61980, 6.0%, 7.8%, 103.11981, 3.6%, 4.1%, 105.7. Source: Best's Aggregates and Averages. As Pogo would say, the future isn't what it used to be. Current pricing practices promise devastating results, particularly if the respite from major natural disasters that the industry has enjoyed in recent years should end. For underwriting experience has been getting worse in spite of good luck, not because of bad luck. In recent years, hurricanes have stayed at sea and motorists have reduced their driving. They won't always be so obliging. And, of course, the twin inflations, monetary and social, the tendency of courts and juries to stretch the coverage of policies beyond what insurers, relying upon contract terminology and precedent, had expected, are unstoppable. Costs of repairing both property and people, and the extent to which these repairs are deemed to be the responsibility of the insurer, will advance relentlessly. Absent any bad luck, catastrophes, increased driving, etc., an immediate industry volume gain of at least 10% per year probably is necessary to stabilize the record level of underwriting losses that will automatically prevail in mid-1982. Most underwriters expect incurred losses in aggregate to rise at least 10% annually. Each, of course, counts on getting less than his share. Every percentage point of annual premium growth below the 10% equilibrium figure quickens the pace of deterioration. Quarterly data in 1981 underscore the conclusion that a terrible underwriting picture is worsening at an accelerating rate. In the 1980 annual report, we discussed the investment policies that have destroyed the integrity of many insurers' balance sheets, forcing them to abandon underwriting discipline and write business at any price in order to avoid negative cash flow. It was clear that insurers with large holdings of bonds valued, for accounting purposes, at nonsensically high prices would have little choice but to keep the money revolving by selling large numbers of policies at nonsensically low prices. Such insurers necessarily fear a major decrease in volume more than they fear a major underwriting loss. But, unfortunately, all insurers are affected. It's difficult to price much differently than your most threatened competitor. This pressure continues unabated and adds a new motivation to the others that drive many insurance managers to push for business. worship of size over profitability, and the fear that market share surrendered never can be regained.
Whatever the reasons, we believe it is true that virtually no major property casualty insurer, despite protests by the entire industry that rates are inadequate and great selectivity should be exercised, has been willing to turn down business to the point where cash flow has turned significantly negative.
Absent such a willingness, prices will remain under severe pressure. Commentators continue to talk of the underwriting cycle, usually implying a regularity of rhythm and a relatively constant midpoint of profitability. Our own view is different. We believe that very large, although obviously varying, underwriting losses will be the norm for the industry, and that the best underwriting years in the future decade may appear substandard against the average year of the past decade. We have no magic formula to insulate our controlled insurance companies against this deteriorating future. Our managers, particularly Phil Leach, Bill Lyons, Roland Miller, Floyd Taylor and Milt Thornton, have done a magnificent job of swimming against the tide. We have sacrificed much volume, but have maintained a substantial underwriting superiority in relation to industry-wide results. The outlook at Berkshire is for continued low volume. Our financial position offers us maximum flexibility, a very rare condition in the property casualty insurance industry. And, at some point, should fear ever prevail throughout the industry, our financial strength could become an operational asset of immense value. We believe that Geico Corporation, our major non-controlled business operating in this field, is, by virtue of its extreme and improving operating efficiency, in a considerably more protected position than almost any other major insurer. Geico is a brilliantly run implementation of a very important business idea. Shareholder-designated contributions, our new program enabling shareholders to designate the recipients of corporate charitable contributions, was greeted with extraordinary enthusiasm. A copy of the letter sent October 14, 1981, describing this program appears on pages 51 to 53. Of 932,206 shares eligible for participation, shares where the name of the actual owner appeared on our stockholder record, 95.6% responded. Even excluding Buffett-related shares, the response topped 90%. In addition, more than 3% of our shareholders voluntarily wrote letters or notes, all but one approving of the program. Both the level of participation and of commentaries surpass any shareholder response we have witnessed, even when such response has been intensively solicited by corporate staff and highly paid professional proxy organizations. In contrast, your extraordinary level of response occurred without even the nudge of a company-provided return envelope. This self-propelled behavior speaks well for the program, and speaks well for our shareholders. Apparently, the owners of our corporation like both possessing and exercising the ability to determine where gifts of their funds shall be made. The "Father Knows Best" school of corporate governance will be surprised to find that none of our shareholders sent in a designation sheet with instructions that the officers of Berkshire, in their superior wisdom, of course, make the decision on charitable funds applicable to his shares. Nor did anyone suggest that his share of our charitable funds be used to match contributions made by our corporate directors to charities of the director's choice, a popular, proliferating and non-publicized policy at many large corporations. All told, $1,783,655 of shareholder-designed contributions were distributed to about 675 charities. In addition, Berkshire and subsidiaries continue to make certain contributions pursuant to local-level decisions made by our operating managers. There will be some years, perhaps 2 or 3 out of 10, when contributions by Berkshire will produce substandard tax deductions, or none at all. In those years we will not effect our shareholder-designated charitable program. In all other years we expect to inform you about October 10 of the amount per share that you may designate. A reply form will accompany the notice, and you will be given about 3 weeks to respond with your designation. To qualify, your shares must be registered in your own name or the name of an owning trust, corporation, partnership or estate, if applicable, on our stockholder list of September 30, or the Friday preceding if such date falls on a Saturday or Sunday. Our only disappointment with this program in 1981 was that some of our shareholders, through no fault of their own, missed the opportunity to participate. The Treasury Department ruling allowing us to proceed without tax uncertainty was received early in October. The ruling did not cover participation by shareholders whose stock was registered in the name of nominees, such as brokers, and additionally required that the owners of all designating shares make certain assurances to Berkshire. These assurances could not be given us in effective form by nominee holders. Under these circumstances, we attempted to communicate with all of our owners promptly, via the October 14 letter, so that, if they wished, they could prepare themselves to participate by the November 13 record date. It was particularly important that this information be communicated promptly to stockholders whose holdings were in nominee name, since they would not be eligible unless they took action to re-register their shares before the record date. Unfortunately, communication to such non-record shareholders could take place only through the nominees. We therefore strongly urged those nominees, mostly brokerage houses, to promptly transmit our letter to the real owners. We explained that their failure to do so could deprive such owners of an important benefit. The results from our urgings would not strengthen the case for private ownership of the U.S. Postal Service. Many of our shareholders never heard from their brokers, as some shareholders told us after reading news accounts of the program. Others were forwarded our letter too late for action.
One of the largest brokerage houses claiming to hold stock for 60 of its clients, about 4% of our shareholder population, apparently transmitted our letter about 3 weeks after receipt, too late for any of the 60 to participate.
Such lassitude did not pervade all departments of that firm. It billed Berkshire for mailing services within 6 days of that belated and ineffectual action. We recite such horror stories for 2 reasons. 1. If you wish to participate in future designated contribution programs, be sure to have your stock registered in your name well before September 30th. And, 2. Even if you don't care to participate and prefer to leave your stock in nominee form, it would be wise to have at least one share registered in your own name.
By so doing, you can be sure that you will be notified of any important corporate news at the same time as all other shareholders.
The designated contributions idea, along with many other ideas that have turned out well for us, was conceived by Charlie Munger, Vice Chairman of Berkshire and Chairman of Blue Chip. Irrespective of titles, Charlie and I work as partners in managing all controlled companies. To almost a sinful degree, we enjoy our work as managing partners. And we enjoy having you as our financial partners. Warren E.
Buffett, Chairman of the Board, 1982 letter, Berkshire Hathaway Inc. March 3, 1983, to the stockholders of Berkshire Hathaway Inc. Operating earnings of $31.5 million in 1982 amounted to only 9.8% of beginning equity capital, valuing securities at cost, down from 15.2% in 1981 and far below our recent high of 19.4% in 1978.
This decline largely resulted from 1. A significant deterioration in insurance underwriting results. 2. A considerable expansion of equity capital without a corresponding growth in the businesses we operate directly. And 3. A continually enlarging commitment of our resources to investment in partially owned, non-operated businesses. Accounting rules dictate that a major part of our pro rata share of earnings from such businesses must be excluded from Berkshire's reported earnings.
It was only a few years ago that we told you that the operating earnings, equity capital percentage, with proper allowance for a few other variables, was the most important yardstick of single-year managerial performance. While we still believe this to be the case with the vast majority of companies, we believe its utility in our own case has greatly diminished. You should be suspicious of such an assertion. Yardsticks seldom are discarded while yielding favorable readings. But when results deteriorate, most managers favor disposition of the yardstick rather than disposition of the manager. To managers faced with such deterioration, a more flexible measurement system often suggests itself. Just shoot the arrow of business performance into a blank canvas and then carefully draw the bullseye around the implanted arrow. We generally believe in preset, long-lived and small bullseyes. However,
Because of the importance of item 3, above, further explained in the following section, we believe our abandonment of the operating earnings, equity capital bullseye to be warranted. Non-reported ownership earnings. The appended financial statements reflect accounting earnings that generally include our proportionate share of earnings from any underlying business in which our ownership is at least 20%. Below the 20% ownership figure, however, only our share of dividends paid by the underlying business units is included in our accounting numbers. Undistributed earnings of such less than 20% owned businesses are totally ignored. There are a few exceptions to this rule. E.g., we own about 35% of Geico Corporation, but, because we have assigned our voting rights, the company is treated for accounting purposes as a less than 20% holding. Thus, dividends received from Geico in 1982 of $3.5 million after tax are the only item included in our accounting earnings. An additional $23 million that represents our share of Geico's undistributed operating earnings for 1982 is totally excluded from our reported operating earnings. If Geico had earned less money in 1982 but had paid an additional $1 million in dividends, our reported earnings would have been larger despite the poorer business results. Conversely, if Geico had earned an additional $100 million and retained it all, our reported earnings would have been unchanged. Clearly, accounting earnings can seriously misrepresent economic reality. We prefer a concept of economic earnings that includes all undistributed earnings, regardless of ownership percentage. In our view, the value to all owners of the retained earnings of a business enterprise is determined by the effectiveness with which those earnings are used, and not by the size of one's ownership percentage. If you have owned 0.01% of Berkshire during the past decade, you have benefited economically in full measure from your share of our retained earnings, no matter what your accounting system. Proportionately, you have done just as well as if you had owned the magic 20%. But if you have owned 100% of a great many capital-intensive businesses during the decade, retained earnings that were credited fully and with painstaking precision to you under standard accounting methods have resulted in minor or zero economic value. This is not a criticism of accounting procedures. We would not like to have the job of designing a better system. It's simply to say that managers and investors alike must understand that accounting numbers are the beginning, not the end, of business valuation. In most corporations, less than 20% ownership positions are unimportant, perhaps, in part, because they prevent maximization of cherished reported earnings, and the distinction between accounting and economic results we have just discussed matters little. But in our own case, such positions are of very large and growing importance. Their magnitude, we believe, is what makes our reported operating earnings figure of limited significance. In our 1981 annual report, we predicted that our share of undistributed earnings from 4 of our major non-controlled holdings would aggregate over $35 million in 1982. With no change in our holdings of 3 of these companies, Geico, General Foods and The Washington Post, and a considerable increase in our ownership of the 4th, R.J. Reynolds Industries, our share of undistributed 1982 operating earnings of this group came to well over $40 million. This number, not reflected at all in our earnings, is greater than our total reported earnings, which include only the $14 million in dividends received from these companies. And, of course, we have a number of smaller ownership interests that, in aggregate, had substantial additional undistributed earnings. We attach real significance to the general magnitude of these numbers, but we don't believe they should be carried to 10 decimal places. Realization by Berkshire of such retained earnings through improved market valuations is subject to very substantial, but indeterminate, taxation. And while retained earnings over the years, and in the aggregate, have translated into at least equal market value for shareholders, the translation has been both extraordinarily uneven among companies and irregular and unpredictable in timing. However, this very unevenness and irregularity offers advantages to the value-oriented purchaser of fractional portions of businesses. This investor may select from almost the entire array of major American corporations, including many far superior to virtually any of the businesses that could be bought in their entirety in a negotiated deal. And fractional interest purchases can be made in an auction market where prices are set by participants with behavior patterns that sometimes resemble those of an army of manic depressive lemmings. Within this gigantic auction arena, it is our job to select businesses with economic characteristics allowing each dollar of retained earnings to be translated eventually into at least $1 of market value. Despite a lot of mistakes, we have so far achieved this goal.
In doing so, we have been greatly assisted by Arthur O'Coon's patron saint for economists, Street. Offset.
In some cases, that is, retained earnings attributable to our ownership position have had insignificant or even negative impact on market value, while in other major positions $1 retained by an investee corporation has been translated into $2 or more of market value. To date, our corporate overachievers have more than offset the laggards. If we can continue this record, it will validate our efforts to maximize economic earnings, regardless of the impact upon accounting earnings. Satisfactory as our partial ownership approach has been, what really makes us dance is the purchase of 100% of good businesses at reasonable prices. We've accomplished this feat a few times, and expect to do so again, but it is an extraordinarily difficult job, far more difficult than the purchase at attractive prices of fractional interests. As we look at the major acquisitions that others made during 1982, our reaction is not envy, but relief that we were non-participants.
For in many of these acquisitions, managerial intellect wilted in competition with managerial adrenaline. The thrill of the chase blinded the pursuers to the consequences of the catch.
Pascal's observation seems apt. It has struck me that all men's misfortunes spring from the single cause that they are unable to stay quietly in one room. Your chairman left the room once too often last year and almost starred in the acquisition follies of 1982.
In retrospect, our major accomplishment of the year was that a very large purchase to which we had firmly committed was unable to be completed for reasons totally beyond our control.
Had it come off, this transaction would have consumed extraordinary amounts of time and energy, all for a most uncertain payoff. If we were to introduce graphics to this report, illustrating favorable business developments of the past year, 2 blank pages depicting this blown deal would be the appropriate centerfold. Our partial ownership approach can be continued soundly only as long as portions of attractive businesses can be acquired at attractive prices.
We need a moderately priced stock market to assist us in this endeavor.
The market, like the Lord, helps those who help themselves. But, unlike the Lord, the market does not forgive those who know not what they do. For the investor, a too high purchase price for the stock of an excellent company can undo the effects of a subsequent decade of favorable business developments.
Should the stock market advance to considerably higher levels, our ability to utilize capital effectively in partial ownership positions will be reduced or eliminated. This will happen periodically. Just 10 years ago, at the height of the two-tier market mania, with high return on equity businesses bid to the sky by institutional investors, Berkshire's insurance subsidiaries owned only $18 million in market value of equities, excluding their interest in blue-chip stamps.
At that time, such equity holdings amounted to about 15% of our insurance company investments versus the present 80%. There were as many good businesses around in 1972 as in 1982, but the prices the stock market placed upon those businesses in 1972 looked absurd. While high stock prices in the future would make our performance look good temporarily, they would hurt our long-term business prospects rather than help them.
We currently are seeing early traces of this problem.
Long-term corporate performance. Our gain in net worth during 1982, valuing equities held by our insurance subsidiaries at market value, less capital gain taxes payable if unrealized gains were actually realized, amounted to $208 million.
On a beginning net worth base of $519 million, the percentage gain was 40%.
During the 18-year tenure of present management, book value has grown from $19.46 per share to $737.43 per share, or 22.0% compounded annually. You can be certain that this percentage will diminish in the future. Geometric progressions eventually forge their own anchors. Berkshire's economic goal remains to produce a long-term rate of return well above the return achieved by the average large American corporation.
Our willingness to purchase either partial or total ownership positions in favorably situated businesses, coupled with reasonable discipline about the prices we are willing to pay, should give us a good chance of achieving our goal. Again, this year the gain in market valuation of partially owned businesses outpaced the gain in underlying economic value of those businesses.
For example, $79 million of our $208 million gain is attributable to an increased market price for Geico.
This company continues to do exceptionally well, and we are more impressed than ever by the strength of Geico's basic business idea and by the management skills of Jack Byrne. Although not found in the Catechism of the Better Business Schools, "Let Jack do it" works fine as a corporate creed for us. However, Geico's increase in market value during the past 2 years has been considerably greater than the gain in its intrinsic business value, impressive as the latter has been. We expected such a favorable variation at some point, as the perception of investors converged with business reality. And we look forward to substantial future gains in underlying business value accompanied by irregular, but eventually full, market recognition of such gains. Year-to-year variances, however, cannot consistently be in our favor.
Even if our partially owned businesses continue to perform well in an economic sense, there will be years when they perform poorly in the market. At such times our net worth could shrink significantly. We will not be distressed by such a shrinkage. If the businesses continue to look attractive and we have cash available, we simply will add to our holdings at even more favorable prices. Sources of reported earnings. The table below shows the sources of Berkshire's reported earnings. In 1981 and 1982, Berkshire owned about 60% of blue-chip stamps which, in turn, owned 80% of Wesco Financial Corporation. The table displays aggregate operating earnings of the various business entities, as well as Berkshire's share of those earnings. All of the significant gains and losses attributable to unusual sales of assets by any of the business entities are aggregated with securities transactions in the line near the bottom of the table, and are not included in operating earnings. Earnings before income taxes. Net earnings after tax. Total Berkshire share O of $S1982, 1981, 1982, 1981, 1982, 1981. Operating earnings. Underwriting, $21,558, $1,478, $21,558, $1,478, $11,345, $798. Net investment income $41,620, $38,823, $41,620, $38,823, $35,270, $32,401. Berkshire Wambeck Textiles, $1,545, $2,669, $1,545, $2,669, $862, $1,493. Associated Retail Stores $914, $1,763, $914, $1,763, $446, $759. See's Candies $23,884, $20,961, $14,235, $12,493, $6,914, $5,910. Buffalo Evening News $1,215, $1,217, $724, $725, $226, $320. Blue Chip Stamps. Parent $4,182, $3,642, $2,492, $2,171, $2,472, $2,134. Wesco Financial. Parent $6,156, $4,495, $2,937, $2,145, $2,210, $1,590. Mutual Savings and Loan. $1,605, $2, $766, $1,524, $1,536, Precision Steel $1,035, $3,453, $493, $1,648, $265, $841, Interest on debt $14,996, $14,656, $12,977, $12,649, $6,951, $6,671. Other asterisk $2,631, $2,985, $1,857, $1,992, $1,780, $1,513. Operating earnings $41,102, $60,663, $27,742, $47,236, $31,497, $39,421. Sale of securities and unusual sales of assets $36,651, $37,801, $21,875, $33,150, $14,877, $23,183. Total earnings all entities $77,753, $98,464, $49,617, $80,386, $46,374, $62,604. Asterisk amortization of intangibles arising in accounting for purchases of businesses, IECs, Mutual and Buffalo Evening News, is reflected in the category designated as Other. On pages 45 to 61 of this report we have reproduced the narrative reports of the principal executives of Blue Chip and Wesco, in which they describe 1982 operations. A copy of the full annual report of either company will be mailed to any Berkshire shareholder upon request to Mr. Robert H. Bird for Blue Chip Stamps, 5801 Southeastern Avenue, Los Angeles, California, 90040, or to Mrs. Jean Leach for Wesco Financial Corporation, 315 East Colorado Boulevard, Pasadena, California, 91109. I believe you will find the Blue Chip chronicle of developments in the Buffalo newspaper situation particularly interesting. There are now only 14 cities in the United States with a daily newspaper whose weekday circulation exceeds that of the Buffalo News. But the real story has been the growth in Sunday circulation. 6 years ago, prior to introduction of a Sunday edition of the News, the long-established Courier Express, as the only Sunday newspaper published in Buffalo, had circulation of 272,000. The News now has Sunday circulation of 367,000, a 35% gain, even though the number of households within the primary circulation area has shown little change during the 6 years. We know of no city in the United States with a long history of 7-day newspaper publication in which the percentage of households purchasing the Sunday newspaper has grown at anything like this rate. To the contrary, in most cities household penetration figures have grown negligibly, or not at all. Our key managers in Buffalo, Henry Urban, Stan Lipsey, Murray Light, Clyde Pinson, Dave Perona and Dick Feather, deserve great credit for this unmatched expansion in Sunday readership. As we indicated earlier, undistributed earnings in companies we do not control are now fully as important as the reported operating earnings detailed in the preceding table. The distributed portion of non-controlled earnings, of course, finds its way into that table primarily through the net investment income segment of insurance group earnings. We show below Berkshire's proportional holdings in those non-controlled businesses for which only distributed earnings, dividends, are included in our earnings.
No of shares company cost, O omitted, market, O omitted, 460,650, Affiliated Publications, Inc., $3,516, $16,929, $908,800, C. Crum & Forster $47,144, $48,962, $2,101,244, B. General Foods, Inc., $66,277, $83,680, $7,200,000, Geico Corporation $47,138, $309,600, $2,379,200. Handy and Harman $27,318, $46,692, $711,180. Interpublic Group of Companies $4,531, $34,314, $282,500. Media General, Inc.
$4,545, $12,289, $391,400. Ogilvy and Mather International, Inc. $3,709, $17,319, $3,107,675. B. R. J.
Reynolds Industries $142,343, $158,715, $1,531,391. Time, Inc. $45,273, $79,824, $1,868,600. The Washington Post Company Class B $10,628, $103,240, total $402,422, $911,564. All other common stockholdings $21,611, $21,611, total common stocks $424,033, $945,622. All owned by Berkshire or its insurance subsidiaries.
B. Blue Chip and/or Wesco own shares of these companies. All numbers represent Berkshire's net interest in the larger gross holdings of the group. C. Temporary holding as cash substitute. In case you haven't noticed, there is an important investment lesson to be derived from this table. Nostalgia should be weighted heavily in stock selection.
Our two largest unrealized gains are in Washington Post and Geico, companies with which your chairman formed his first commercial connections at the ages of 13 and 20. Respectively, after straying for roughly 25 years, we returned as investors in the mid-1970s.
The table quantifies the rewards for even long-delayed corporate fidelity. Our controlled and non-controlled businesses operate over such a wide spectrum that detailed commentary here would prove too lengthy. Much financial and operational information regarding the controlled businesses is included in management's discussion on pages 34 to 39, and in the narrative reports on pages 45 to 61. However, our largest area of business activity has been, and almost certainly will continue to be, the property casualty insurance area. So commentary on developments in that industry is appropriate. Insurance industry conditions. We show below an updated table of the industry statistics we utilized in last year's annual report. Its message is clear. Underwriting results in 1983 will not be a sight for the squeamish.
Yearly change in premium written, %. Yearly change in premium earned, %. Combined ratio after policyholder dividends 1972 10.2 10.9 96.2 1973 8.08.8 99.2 1974 6.2 6.9 105.4 1975 11.09.6 107.9 1976 21.9 19.4 102.4 1977 19.8 20.5 97.2 1978 12.8 14.3 97.5 1979 10.3 10.4 100.6 1986.07.8 103.1 1981. Reverend. 1982. Est. 3.95.14.14.6 106.0 109.5 Source. Best's aggregates and averages. The Best's data reflect the experience of practically the entire industry, including stock, mutual and reciprocal companies. The combined ratio represents total operating and loss costs as compared to revenue from premiums. A ratio below 100 indicates an underwriting profit, and one above 100 indicates a loss. For reasons outlined in last year's report,
as long as the annual gain in industry premiums written falls well below 10%, you can expect the underwriting picture in the next year to deteriorate. This will be true even at today's lower general rate of inflation. With the number of policies increasing annually, medical inflation far exceeding general inflation, and concepts of insured liability broadening, it is highly unlikely that yearly increases in insured losses will fall much below 10%. You should be further aware that the 1982 combined ratio of 109.5 represents a best-case estimate.
In a given year, it is possible for an insurer to show almost any profit number it wishes, particularly if it 1. Writes long-tail business coverage where current costs can be only estimated, because claim payments are long delayed, 2. Has been adequately reserved in the past, or 3. Is growing very rapidly.
There are indications that several large insurers opted in 1982 for obscure accounting and reserving maneuvers that mask significant deterioration in their underlying businesses. In insurance, as elsewhere, the reaction of weak managements to weak operations is often weak accounting. It's difficult for an empty sack to stand upright. The great majority of managements, however, try to play it straight. But even managements of integrity may subconsciously be less willing in poor profit years to fully recognize adverse loss trends. Industry statistics indicate some deterioration in loss reserving practices during 1982, and the true combined ratio is likely to be modestly worse than indicated by our table.
The conventional wisdom is that 1983 or 1984 will see the worst of underwriting experience, and then, as in the past, the cycle will move significantly and steadily toward better results.
We disagree because of a pronounced change in the competitive environment, hard to see for many years but now quite visible. To understand the change, we need to look at some major factors that affect levels of corporate profitability generally. Businesses in industries with both substantial overcapacity and a commodity product, indifferentiated in any customer important way by factors such as performance, appearance, service support, etc., are prime candidates for profit troubles. These may be escaped, true, if prices or costs are administered in some manner and thereby insulated at least partially from normal market forces. This administration can be carried out, legally through government intervention. Until recently, this category included pricing for truckers and deposit costs for financial institutions, b. illegally through collusion, or c. extra-legally through OPEC-style foreign cartelization, with tag-along benefits for domestic non-cartel operators.
If, however, costs and prices are determined by full-bore competition, there is more than ample capacity, and the buyer cares little about whose product or distribution services he uses. Industry economics are almost certain to be unexciting.
They may well be disastrous.
Hence the constant struggle of every vendor to establish and emphasize special qualities of product or service.
This works with candy bars. Customers buy by brand name, not by asking for a 2-ounce candy bar, but doesn't work with sugar. How often do you hear, "I'll have a cup of coffee with cream and C&H sugar, please"? In many industries, differentiation simply can't be made meaningful. A few producers in such industries may consistently do well if they have a cost advantage that is both wide and sustainable. By definition, such exceptions are few, and, in many industries, are non-existent. For the great majority of companies selling commodity products, a depressing equation of business economics prevails. Persistent overcapacity without administered prices, or costs, equals poor profitability. Of course, overcapacity may eventually self-correct, either as capacity shrinks or demand expands. Unfortunately for the participants, such corrections often are long delayed. When they finally occur, the rebound to prosperity frequently produces a pervasive enthusiasm for expansion that, within a few years, again creates overcapacity and a new profitless environment. In other words, nothing fails like success. What finally determines levels of long-term profitability in such industries is the ratio of supply tight to supply ample years. Frequently that ratio is dismal. It seems as if the most recent supply tight period in our textile business, it occurred some years back, lasted the better part of a morning. In some industries, however, capacity-tight conditions can last a long time. Sometimes actual growth in demand will outrun forecasted growth for an extended period. In other cases, adding capacity requires very long lead times because complicated manufacturing facilities must be planned and built. But in the insurance business, to return to that subject, capacity can be instantly created by capital plus an underwriter's willingness to sign his name. Even capital is less important in a world in which state-sponsored guarantee funds protect many policyholders against insurer insolvency. Under almost all conditions except that of fear for survival, produced, perhaps, by a stock market debacle or a truly major natural disaster, the insurance industry operates under the competitive sword of substantial overcapacity. Generally, also, despite heroic attempts to do otherwise, the industry sells a relatively undifferentiated commodity-type product. Many insureds, including the managers of large businesses, do not even know the names of their insurers. Insurance, therefore, would